Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Mark Higgins. How you doing today, Mark?
Good. How you doing, Kirk? Thanks for having me.
Good. Well, thanks for coming on the show. So wanted to bring Mark on. We like bringing on, as we say in Boston, wicked smart people. We really wanted to kind of expand the conversations here as we talk about on the show every week. There's a lot going on in the markets, and we wanted to bring on somebody to bring in a different perspective. So, Mark, why don't you tell us a bit about your background?
Sure. I was an investment consultant for large pensions, foundations, endowments, and corporate plans for about 12 years. And when COVID hit, I started reading. I had some more free time, like everybody. And I started reading a lot about financial history. And I pretty quickly discovered that the more I read about history, the easier it was to interpret what was happening in the present. And I ended up reading quite a bit. Literally tens of thousands of pages, and discovered that there hadn't been a book written on the full financial history of the United States. So I took a shot at writing that. It's done. It'll be out in February 2024. But more importantly, it's really given me a foundation to help people understand what's happening in the present, and to understand myself what's happening in the present by seeing the things that repeat in history. And I've discovered that most things that are happening in the present actually are some type of permutation of the past. And that's what we were going to hope to talk about today.
Nice. Well, as I say, those who don't know history are doomed to repeat it, right?
That's right.
That's the
That's
famous
right.
phrase.
Happens more than you can imagine.
Yeah, so let's dive in a little bit. You mentioned before COVID and how that impacted the markets, the economy, and as I said before the show, obviously this has happened before. So
Mhm.
let's talk a little bit about it, because I think it's helpful given the context of what's going on now and what people can expect going forward. So what's kind of your thoughts on the COVID pandemic, what happened, what we can expect, and all that?
So it was, and this is actually a theme that I talk about quite a bit in the book, is when the present is usually not an exact repetition of the past. It's usually some combination from different periods. And I wrote a paper on this. It's available online. And if you look at the COVID-19 pandemic, there are a few events that stick out. First of all, the panic that hit in March 2020 was very much reminiscent of the July 1914 panic. Nobody saw World War I coming, and all of a sudden the entire world shut down. The New York Stock Exchange actually shut down for 4.5 months. So that was the precedent there. And you had the same kind of, massive stimulus and monetary support at the time as well, to prevent the country from spiraling down into a depression. The most relevant period, though, really started in April 2021, when you had the kind of the worst period of COVID was ending. All that pent up savings was getting deployed. You had supply chain disruptions, and you saw the inflation kick in the United States. And that was very much like the 1919 and 1920 period, which followed the end of World War One and the end of the Great Influenza, which kind of ended at the same time. And you had the same dynamic. You had, the economies, global economies switching back from a wartime to a peacetime. You had supply chain disruptions, same dynamic. And then now when you get to today, inflation's been going on for about 2 years now. The Fed has responded aggressively, just like they did in 1920. But you also have the added element of, there are two things that the Fed fears more than anything else. One is repeating the Great Depression, and two is repeating the Great Inflation from 1965 to 1982. So that explains why they're acting so aggressively. When you read the minutes, when you hear Powell speak, you'll hear, getting the job done. That's what that's the language that Volcker used. You'll hear references to that period, and that is really driving their mentality. And knowing this was really helpful about a year and a half ago, when people were kind of skeptical, because the Fed's been dovish for 40 years. But when they're placed in this position, there's little choice. They have to be aggressive. And knowing that history help kind of foresee that.
Nice. No, I love that. It's we're a student of history here as well. we talk, especially now with the inflation, we talk a lot about the 70s, the period of the 70s and the early 80s.
Yeah.
And we feel that's kind of, I don't want to say a mirror image, but a lot of similarities to what we're experiencing now.
Yeah.
Here's a question I have. So my thesis has been that the market doesn't agree, which is always kind of weird when you don't agree with the market, right? It just makes you feel like, what are you missing? But,
Yeah.
the market seems to think everything's fine. But we went from a 0% inflation rate or close to zero and 0% interest rate for like basically the greater part of 20 years. And now we're up to 5.5%, depending on what day people are actually listening to this. And so, you have that inflation that happened. The Fed is trying to fight inflation. But they're fighting a battle where they have to pick which way they want it to go. Do we fight inflation, send us into recession, or do we try to keep the stock market and the economy balanced so we don't go into recession? I feel like they've been fighting recessions for the last 40 years, not necessarily inflation, and now they're fighting inflation. So where do you think they're going to go with this? Like, what do you think is going to color their decisions going forward?
I think what is coloring their decision is, so if you look back at the real mistakes of the great inflation were made in the late 1960s, when the Fed was just overly loose and very vulnerable to political pressure, and they didn't tighten policy enough to stop inflation from setting in. And once it set in, and then they would tighten and back off prematurely, higher inflation expectations set in. And once that happens, it is really hard to break the cycle. And I think that's what's in the Fed's mind right now, is we cannot repeat what we got wrong in the late 1960s and let inflation expectations get elevated, which they're not yet. Because if they do, then you got a real problem. And that's why Volcker had to raise rates all the way up to 20%. It wasn't just breaking inflation, it was breaking inflation expectations, which is a much more sticky problem to attack. So that's what I think they're doing. There's an interesting, I went on a trip to England a year ago, and there's an exhibit I'm a nerd, so I go to I take my son to the Bank of England museum, and it was actually pretty cool. He got to hold like a $2 million gold bar. Is actually pretty cool. But they have this exhibit where there's this air tube, and you have a little ball that you have to balance at the 2% inflation target. And then you press a button and it shakes the tube, and it's really hard to get it back. And that's what the Fed is dealing with right now, right? You had inflation at a high level. You have to tighten monetary policy to get it back. It's really hard to get it back at that 2% and then just stop it. And that's why it may not seem like it right now, but I do feel like, just historically speaking, a period of, brief period of deflation and a recession is the most likely outcome. That's what happened in 1921 after the Fed jacked rates 225 basis points in 6 months. That's all it took back then. That's what happened in the 1980s, and I think that's the most likely outcome. And it's just because it's really hard. What you're really dealing with is price instability, right? I mean, you're unstable on one end. It's hard when you're unstable on the other end too to bring it back without causing inflation. So that's just the nature of price instability.
So here's the question. So you think that the Fed is going to side with fighting inflation, which they've actually, to be fair, they've been very clear about, right? Powell's come out and said, we're going to destroy demand, which basically means we're going to send you into recession. But
they don't have a choice. They don't have a choice.
However, here's the question, and this is something that just hit me in the last month, is I've been talking about this for like the last year and a half, is that they're going to pick fighting inflation. And the market's like, no, they're not going. They'll be back to zero, and now we're up to 5%, right? I think they're going to be higher a lot longer than most people think. But here's the question. So if you're looking at inflation, they're trying to fight inflation. Inflation's at 4. Mm-hmm. You could argue that it's possibly lower, depending on which metrics you look at. Yeah. And I think that my thesis, and it's kind of a low probability thesis, but I look at this thesis, I think, it's possible we could hit 0% inflation by the end of the year. Because if real estate starts to go down, That's 45% of CPI. So it's possible we could have negative inflation this year. So here's the question. If we go to 2% or 0 or whatever it is on inflation, does the Fed still stick with the 5%, or are they afraid of deflation, which of course, like you're talking about the air tube, deflation is just as much, if not more of a problem for the Fed. So do they try to fight deflation and then they drop rates and then we have this high inflation again? So like,
This
how do
is
they
the
balance
this
that?
is this is
Right.
the Bank of England thing. It's
Right.
hard to get it back. You know, like they're probably gonna overshoot.
Yeah.
We're gonna have a brief period of deflation, and then they're gonna lower. What happened in I do think the best comparable is what happened in 1920, 1921, and 1922, and that's exactly what happened. So they jacked rates in 1920, yet it was technically a depression. In 1921, and then they reversed course and cut rates aggressively. And that, you know, if history repeats, that is the most likely scenario.
Okay. So you
I
think
think your thesis is right.
okay, because because they've always been afraid of deflation, right? And that's a
Yeah.
bigger fear because we become Japan and then
Yeah.
we're all screwed, right?
Yeah.
I mean, it's,
Yeah.
Japan will be the first to go and see when deflation is going to be a problem, but they have a different culture than we have here. I mean,
Yeah.
collectively, the country has accepted lower wages, lower prices, and everyone collectively has accepted that, so they don't lay people off. Like in our country, we just fire a bunch of people.
Yeah.
And ours are quicker, but theirs is more of a community base, and they've maintained it. Yeah, I don't know how, but they maintained it. So, all right. So you think that they're going to do that? They're going to keep rates high, if not raise them, because the other thing is, where's the recession? we just climbed the quickest in rates since the 70s, and yet we still don't have. There's no sign. There's very minor signs of recession, but almost none.
Yeah, I mean, I'll be honest with you. I thought we would have a recession by now. I just think there was more pent up. It's just going to take more tightening to cause it. You know, is it possible that we have a soft landing? Sure. History, we don't have that many historical periods to use as a basis, but the two we have that are most comparable, I do think 1920 and 1921, that tightening cycle is the most comparable. Next, I guess, is you know, the Volcker tightening cycle, but I do think that was a different dynamic because you had high expectations entrenched. I think that was a worse situation. But you know, if it repeats like it so far has, like 1920, 1921, I think you're gonna err on going too far in the other direction, even if it doesn't seem that way. To me, it's less about looking at the data, the current market data. It's more about thinking about what is the motive of the Fed and how far do they need to go to stop it. And if it's the same as it was in the last comparable situation, you're going to have a similar outcome. If they navigate a soft landing, my hat's off to them, because it's really hard to do.
It feels that way right now, though. It feels like we're heading into a soft landing because there's no recession in sight. We have high rates, so there's no reason to drop them. And the market's thinking they're going to drop them in a year or two. And there's no reason, because even if they stay at 5.5, and nothing changes, then why ever drop them? There's no reason to drop them. And this is the other thing. What if inflation goes down to 2 or 1, and we have, so I don't know how likely this is. It seems completely unlikely, but also it's what we're experiencing right now. Is you have 5.5% interest rates. You have a low inflation, a low CPI. Let's call it 2. Right now it's 4, but let's say it goes down to 2, which is their kind of target, wherever they picked that out of a hat. They got a target of 2, and we don't have a recession. Then what happens?
They'll, you know, I don't know, but I mean, the history and the dynamics of price instability strongly suggest to me, I don't care what the data looks like right now, that the most likely outcome is still a recession. If they avoid it, my hat's off to them. You know, they went on that little Bank of England thing, and they navigated it perfectly, and it's not easy to do that.
I'm in agreement with you. Every institutional investor I've talked to, they're all scratching their head thinking, I don't get it. Like, we're all waiting for this recession. Now some of them are coming out and starting to sound bullish. Oh, tech, it's gonna blow the doors off. I'm like, how do you figure? Like, I don't understand how interest rates are not affecting the economy. We had I think it was last week. I saw some statistics. Public companies, I think there were like 6 that
Yeah,
filed for bankruptcy, and within like maybe it was, I'm sorry, maybe it was a 30-day period, but it was a 6, which
yeah,
is the second or third highest. I think the highest was like 8 or 9 in a
yeah.
small period. I just I don't know. To me, the numbers just aren't making sense. Why we're not seeing more of that? Why companies aren't hurting? And
I
I don't know.
mean,
Maybe it just takes time.
I think it does. It's taken a little more time than I thought. The thing that always astounds me is, I mean, just how much money got pumped into the system too. I mean, it was an enormous amount. A lot of it didn't get spent. I don't know if you ever saw the graphics on the personal savings rate during COVID.
Yeah.
I mean, it went from like, 6% 20-year average to like 17% during the COVID. I mean, there was a lot of money on the sidelines. And I think it just took time to wind it down. But um, I still believe that that's the most likely outcome. It's taken longer than I thought. I definitely thought we would have been in a recession by now. And we may not. And I have to concede that that's possible too. I don't think that's the most likely scenario.
Do you think that we're going to have, kind of looking at history, our national debt has gone through the roof. It's just keeps ballooning up. And I'm sure based on the math, they can't do anything but keep doubling it every 6 to 8 years. What do
Very.
you, how do you see that impacting the whole equation? I feel like the numbers that people have been working with for like decades have been dependent upon a normal economy with not an overabundance debt. But now that we do, it's kind of changed the dynamics. So how does all that impact, and what do you think is going to be the end result of that?
The scariest thing about this is the thing that jumped out to me researching 234 years, whatever you want to say, since Hamilton stabilized the debt, or consolidated the debt and honored the debt of the United States in 1790, is for about 175 years, we had a very different attitude toward the use of the public debt. It was for use in emergencies, mainly war. And then during peacetime periods or non-emergency periods, we would pay down the debt. And we did that for 175 years. Then this is my interpretation of what happened. So you had World War II. And in World War II, we were, you had the arsenal of democracy. We built up our industrial infrastructure. The whole world basically got their infrastructure destroyed in World War II. We returned to the gold standard under Bretton Woods, and we had 2/3 of the world's gold. So we were extremely wealthy after World War II, and the whole world was basically destroyed. I mean, that's an exaggeration, but we were intact. They were definitely handicapped in terms of their ability to compete with us. So we had this temporary period of extraordinary wealth, and we started living beyond our means. And that really started in the mid 60s. I would say the Great Society was really the starting point of that. And the problem with that is it seemed like it was sustainable at the time, but as nations caught up to us competitively, specifically Germany and Japan, we were living at a level that we couldn't afford anymore because our economy wouldn't support it. And that mentality has stuck until today. And I don't know how to reverse that. I mean, is it going to be a problem tomorrow? Probably not. Is it going to be a problem in 30 years? Yes, it will. And, what I've also observed about and I talked to my wife about this. She helps me phrase things in a way that, because I think it's pretty urgent, and I struggle not to just, nail it into people's brains. But, the challenge is you can't just cut people off immediately. But if we don't start addressing it gradually to, gradually cut spending, I don't know what you would do with taxes, because there's people just want to raise taxes, but there can be real problems if you do that too, that you need to address. And it could squelch innovation, which has been which has fueled this country for 230 years. But you got to do something gradually. And where I've seen this country is always a battleground of different interest groups, different values. And when we have a crisis, we put them aside. They don't disappear, but we put them aside and we rally together. World War II is a great example of that. But the problem is, like, how can you convince people to rally behind a crisis that will probably occur in 30 or 40 years and start chipping away at it now, and without having a crisis? I don't know how to do that. And you know, that to me is the biggest challenge we have. We have a debt problem, a serious debt problem, but it's probably not going to reach a crisis for, I don't know, call it 15 to 50 years. I don't know when, but it's not tomorrow. And this nation seems to only rally toward a common cause in a crisis. So how do we get people to focus on that for what it is without having an immediate crisis? I don't know if that makes sense, but that's what I struggle with.
Yeah, and here's a thought. So I've talked to so Rob Arnott wrote a great piece about a year and a half ago on the pension crisis. We had him on the show to talk about it, and a friend of mine is kind of looks into the data too. And since you have kind of a background in pensions, I'm curious in your thoughts. But the way that I've seen it, or at least from talking to other people, you know, we have Social Security, Medicare, and pensions are all going to run out of money between 2032 and 2035. So you've got this crisis of, you know, whatever you want to call it, but you're going to run out of money in 10 years, effectively.
Right.
You can't pay for any of those things you need to pay, which means you either got to print more money, which is inevitably what's going to happen. You have to turn the screws on it, right? You have to give people less benefit, higher taxes, print money, all of that at the same time. Like, what do you see from the pension market? Like, do you see that, you know, becoming a big issue, or where do you see that going? Because to me,
I don't,
all that lines up.
I mean, I don't know in aggregate pensions. You know, I've consulted to a few pensions. I would say a general observation, although it is coming down, is, you know, their assumed rates of return were pretty aggressive, but they have been coming down. I don't think they're wildly out of whack long term. You know, I think the average is probably around 7. I don't know. I think 6.5 is probably more appropriate. I don't know what the aggregate underfunding is, but if it's, you know, it's consistent with the federal government is, you know, definitely living beyond its means. And, you know, I think the states are a little more disciplined because they have to be on their annual budgets. But, you know, I wouldn't be surprised. Running out of money in 2032 seems a little, my guess is that seems a little extreme, but, you know, I don't know. I mean, I'd have to look at the numbers.
I mean, those are what's stated by each of the programs, basically.
Okay, well then it's accurate.
So it's not that
yeah.
one of them is going to run out; it's that they're all running out right at the same time. That's the
Yeah,
issue. You know,
yeah,
it's this kind of convergence of problems. I
yeah.
think, you know, I guess what I look at it is at least from the data I've seen is, you know, whatever you want to call it, 6%, between 6 and 7% as being their expectations
Yeah.
of returns. Are those realistic expectations? I mean, that's a big question we need to ask ourselves. Just because we've had those returns for the last 15 years, does it mean we're going to continue to have them? Like, I don't know. I'm
Who
not
knows?
sure.
Who knows? You know, it's hard to, it depends on their allocations. It's hard to generalize that. You know, I would say historically 6.5 over a long period of time where valuations don't really matter. You know, you're talking 50 years where they don't matter that much. That doesn't seem that out of whack to me. But again, it depends on the allocation. You know, this comes to one of the flaws that I've seen is there's too much complexity in these plans, that there's if your returns are constrained and largely controlled by the market, don't screw it up by investing in active managers and failing in that. Don't screw it up by going into private equity when you really don't have the capabilities to pick the top managers. Because if you don't pick the top managers, you know, you're gonna cause damage. And that actually is a big problem, and that's one of the things that I hope to address, that I've witnessed.
So I'm curious, you know, when you talk about, you know, active versus passive, I think it's a good question, especially on the institutional side. You know, if you look at the institutional portfolios, there's been a huge shift in the last few decades to get away from the publicly traded markets into the private side, into private equity, venture capital. And it seems like you look at some of these colleges and like a vast majority of them are in those categories. And yet the individual investor can't do that. are they doing the right thing? Or are they just kind of chasing, I mean, I look at private equity, and everyone I talk to that's in the field are like, yeah, it's way overvalued. And
I
the
agree.
prices aren't sustainable. Yet everyone's still chasing it as if
That's what everyone always does.
right.
They've been doing that for 230 years. There's a funny. I have a article that I co-wrote from a client actually, that's coming out in Financial History magazine next month, and it's about the Panic of 1819. And what happened? It's a pretty amazing story. So in 1815, Mount Tambora erupted and cooled the earth by like literally a degree, which is a lot. And so crops failed throughout the whole world. But the United States wheat crop was actually pretty good, so prices doubled. So all of a sudden, everyone started speculating on Midwestern prices of real estate, and a bubble formed in real estate that caused the panic of eight. It was a big cause of the panic of 1819. You had a huge depression. So people have been doing this for ages. Herd behavior is one of the most damaging behaviors in investing. And you see that. I have a quote here, and it's going to take me a little while to find it, but there was a quote that was in 2005 from an endowment, and basically saying like, look, we had these alternative investments to ourselves. Now everybody's flooding in. Like, we're just not going to get the same returns anymore. And that was 18 years ago. And the problem with private equity, venture capital especially, hedge funds might be even worse, but the problem with these investments is you have to be really skilled. There aren't that many. You have to be in the top quartile, pretty much. I would say top decile for venture capital, and there aren't many people that can find those funds. And then the ones that do find them, it's hard to get access. And if you're not in that top quartile or top decile in some areas, you actually are better off in public markets. And I would argue, individuals can't get in. I would argue a lot of institutions should not be in them. And it's just, there's too many ways to screw up. And then you also have the toughest thing with institutions that you probably don't have to, well, you do have to deal with it, just not as often, is I used to joke about it that, every 5 years their personality changes, and they don't know their personality changes because you basically get frequent turnover, and they don't remember what the other people did. So they're constantly, even if one group is good, the next group can be bad and undo what the first group did, and they don't even know it. And so you have that added element of, even if you are good temporarily, the odds of keeping that going in perpetuity are very, very low. And that's an argument against that. That's a specific argument for institutions against active management and alternatives.
Well, here's a question. So I know the guys at Horizon Kinetics have done a lot of research on this and a lot of thought leadership on this, which is really interesting, which is, at some point, everybody can't index because there's no price discovery. Yeah. So it always raises I thought it was as a good, interesting thought, right? Is that everyone's trying to index. And I'm not saying it's a good or bad thing. I don't know what's good or bad, but I get the thesis, right? Like, low cost, you're basically doing what the market's doing, which I guess is okay, except for last year. Last year didn't do it so well. Yeah. But other than that, like, I get the thesis, but if everybody's indexing, are we creating a problem in of itself? Like, we have, 5 stocks that make up 25% of the S&P 500 and 50% of the NASDAQ. Like, is that a good thing?
So I have 3 responses to that. Okay. The first one is, maybe that is true, but if it is true, the best play is to index until it doesn't make sense anymore and then go active. Like, that's still the best play. I'm actually more skeptical that that'll ever happen. I think there are enough gamblers out there that it doesn't take much. There's Craig Lazara at S&P did a study on this, and I may be getting the numbers wrong here, but I think it was like 70 to 80% penetration is the point where that might be a problem. We're not close to that yet. And the reason is passive doesn't trade a lot. So even if it's most of the money is in passive, the active managers are still the ones doing all the trading, which makes prices efficient. So the threshold, if there is a threshold, is probably higher than people think. I forget what the third thing was, but anyway, maybe I'll remember it. But those are the 2 initial responses that I would give.
Yeah, I mean, that makes sense. I mean, I think like I said, it's a almost a philosophical kind of thought process because we don't know until we know. I just kind of look at it and say, well, why invest in indexes? You just invest in the FANG stocks, which is not investing. It's also gambling. But it's just interesting because value's been out of favor for pretty much 20 some odd years.
Yeah.
Been a few years here and there, but basically, if you own value, you're a bum. Even though value investing, there's almost more legitimacy to that than there is in growth, but yet it doesn't matter because it didn't outperform. And so it's a real question of like, are the markets actually, I don't want to say efficient because I think we've all seen that they're no longer efficient, but is that causing future problems? That people are just everybody's becoming a gambler and they're all just chasing like the hot dot, and it's fine until like one of the FANG stocks blows up, which I'm not saying it will, but you're just taking more risk, and I don't think people understand the risk they're taking. They're just saying, yeah, sure, we're fine, and then COVID or even last year, and so I don't know. It's just, I'm just curious, just because I don't know if this has happened in the past or not, or if this is kind of a new thing.
What do you mean? What's happening
in history? I mean, in history, have there been this kind of concentration? Because
I don't have the data, but if you look at the late 1800s, it was all railroad securities. Then in the early 1900s, it was industrials. I don't know the concentration. I'd have to look at the concentration, but my guess is this is less unique than people think. There have been different periods in U.S. history where different securities have dominated, and they cause overinvestment, and valuations get out of whack, and they correct eventually. So I don't look at it as being that unique.
All right. So let me ask you this. What are some of the biggest challenges we face that we haven't talked about that we may want to kind of touch on here?
The debt is, to me, by far the biggest challenge. The other challenge that haunts me is the growth challenge. So we ran up a lot of debt after World War II. From World War II, but we had exceptional growth that we actually didn't really pay down much of the debt. It just, got reduced as a percentage of GDP because GDP was growing so fast. When you look at the factors that could drive growth going forward, it's hard to see, how we can grow out of it. Hold on a second, let me just find a part in the book where I have a chapter, it's towards the end, and it goes through, what could drive growth going forward. And there are really 5 things. It's population, it's the labor force participation, it's, whatever the natural unemployment rate is, that's actually been going down a bit. So that's, it's positive for growth. The total hours worked per year, so how much people are working in the labor force, and then productivity. And if you break those down, the population is not growing that much, call it 0.3, 0.5%. The natural unemployment rate, let's just call that steady. The labor force participation rate has been going down. It was call it roughly 10 to 15 years ago, it was at 67, now it's at 62. It's projected to go down to 61. Hours worked. I mean, I'm not saying we should go back to where we were, but in 1830, it was 70 hours a week on average. Now it's 35. So, people aren't in the labor force, aren't working as much. And productivity, people underestimate how amazingly unique the productivity growth was from 1920 to 1970, or even in the early 1900s. And we're just not getting that anymore. Even with people think that technology is going to spark this amazing productivity growth, but it's not. And, call it 1 and 1.5%. So if we get 1.5 to 2% total GDP, real GDP growth, that's pretty good going forward. And that's going to, when our debt is growing much faster than that. So the thing that I struggle with is, which of these factors can we move? We can't really move population. Labor force participation, we could move, getting people to work longer, and it doesn't have to be, just crazy labor, but maybe pushing off retirement. Total hours worked. I mean, I know this is not uniform. I'm always talking in aggregate. I'm not saying there aren't people that are not working 70 hours. There are. But that's pretty low, 35 hours a week. So what I struggle with is what levers can we push to improve growth up to a higher level? And that's a real challenge that we have.
So I'm going to ask you a quick follow-up before we wrap it up, because we're hitting on time here, but it kind of gets into your question. So like, how is AI going to impact this? Because that's going to, make the problems worse as I see it. Plus, the other point I was going to ask is about the debt jubilee, about how that in history, that was my thesis in 2008. I wrote a letter to the Fed and talked about like they should basically take all the bad debt, light it on fire. And of course, that presents problems, but that's, so I'm curious on your thoughts on a debt jubilee, because it does have a historical precedent. And, is that something that would be considered, do you think?
I honestly have I saw Ray Dalio writes about that in some of his books, the Jubilees back in, I think it was like 2000 years ago or something like that.
Yeah.
I honestly have not thought through that. I couldn't answer that intelligently, other than to agree with you that the amount of debt is a problem. I'm sorry, what was your...
The other one was AI, the impact on your five things, like AI, like that's going to make the problems worse.
So yeah, I mean, technology, it does add to, by the way, it does add to productivity growth. It's just not as much as people think. Getting running water, electrical appliances, that a car, I mean, that had a bigger impact than technology has been thus far. Now, is AI going to be the one that just brings productivity growth back to 2-3% a year? Maybe. The history of technology development would suggest that that's not going to happen. But it does displace more workers, like you said. I mean, that's been a big trend with technology. So my gut is with AI, it's going to be like, and I'm not an intelligent person on like the specifics of AI, but looking at how technology has impacted the economy since 1946, when the ENIAC came out, the productivity has not been as significant as people think. So I would bet on the under of the impact.
Okay, cool. So this has been a great conversation, Mark. Really appreciate you sharing your wisdom with us. Where can people find more about you?
So you can go to it. I'm probably going to change the name of the site, but right now it's enlightenedinvestor.com. Or you can just go to finhistory.com and it'll redirect there. But the book, again, is coming out in February 2024, covers the full financial history of the United States from 1790 to today. And hope you have a chance to take a look.
Yeah, we'll have you back on probably right around the time of the release. We can talk more about it. I mean, this has been great. I'm sure the next 6 months, a lot's going to change.
Yeah, it's very busy, and but that's a good thing. Something happens, and you can always tie it to the Silicon Valley. And what's most helpful about history is to understand what isn't important, so you can see what it is important. And when you strip it all out, the debt is important, growth impediments are important. When the Silicon Valley thing hit, it was clear that the Fed was going to do something big that weekend, because that was a really dangerous situation. That's how depressions start, when you let those things go. So yeah, when something comes up, definitely feel free to give me a call. I'd be happy to be on the show again, and thank you for having me.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist, because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room, as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Mark. Really appreciate him coming on the show. Now we're into the panel portion of the show where you have our very own Barb Friedberg. Hey, Barb.
Hi, happy to be here.
Great to have you. And we also have our very own Megan Gorman. Hey, Megan.
Hey, how's everybody doing?
Great. Well, glad to have you here as well, as you're our resident financial historian. So can't wait to hear your thoughts today. So let's start with you, Barb. What were some of your takeaways from the interview?
I loved it. I thought he was so smart, and I love hearing about financial history. And as the years pile up on my personal calendar, knowing the past, hearing it discussed, seeing it repeated is fascinating. When he talked about inflation in the 70s and 80s, don't tell anyone, but I lived through those periods. And I think one of the most exciting things we're going to get into today is history is really important. We've seen it repeat again and again and again. But does that mean that we're going to see some version of it in the future? And that's a question I'd really like to delve into.
Yeah,
great. And then Megan, what about you? What are some of your thoughts?
Yeah, first of all, I mean, as you guys know, I'm writing a financial history book. So I found this interview fascinating. And it's the whole Mark Twain thing. History doesn't repeat, it merely rhymes. But I think Barb is hitting on an important topic because, right now the markets have been in a malaise or whatever we're in for like 2 years. And I can tell you, being client facing, and Kirk, you're probably doing the same thing. We spend a lot of time putting charts in front of clients to use facts to ground them to not make bad financial decisions, right? And it's easy to keep somebody in the market when this has been going on for like 2 or 3 months, but we're coming upon like month 23 right now, and it's very, very difficult. So I think one of the things, and I'd love to hear both of your opinions, is when I'm trying to put data in front of the client, right, I always want to think about source, right? So, when you're in the investment industry and you're servicing clients, you get inundated every day with charts and graphs and all this different stuff. And when you are making a decision to put a slide of information for the client, where is the source information really coming from? Is it a legitimate source, right? If you had to go and research that source, would you be able to find the documents that support it? So for instance, and this is not related to financial history, but I was writing something on education funding, and I was using a report from JP Morgan. They provide amazing research in that area. But what I was also doing was reading their footnotes and finding their original sourcing documents and going back and double checking to make sure that there was no inadvertent bias put on the data in regards to education funding. And the good news is it wasn't, because it's JP Morgan and they're well done. But it was also helpful to go back and read the source documents from the college boards, from some of it was athletic scholarships, information from the NCAA, to really get context for what's on the slide. So I say this because as you're trying to navigate this marketplace and your advisor gives you data, don't hesitate to research further or ask what the source of it's from.
That's a great point, Megan. And, we've been talking about this in the show a lot lately. I think we came out last week, depending when the show goes live, we came out last week and we talked about this, where pretty much everything you see now in the media is either propaganda, it's biased, or it's intellectually dishonest. And I know this is a hyperbolic statement by saying everything, but things that are put out for a reason. There's rarely news anymore. It's mostly opinion pieces or done for a purpose. A good example, like what you said, Megan, you even research JP Morgan. You obviously think highly of their stuff. And I'm sure their stuff's great. Goldman Sachs stuff, great. But sometimes people have a bias, right? JP Morgan, Goldman Sachs are investment banks, right? They have to, they want to put a good light on a certain company, as we all know that all these investment banks do that. And so they shade it a little bit to make them look good. And it might not be 100% accurate, right? But mostly accurate. We see this with the, since I got started, they had this thing that they send out to advisors. Are like, oh, well, if, it's not timing the market, it's timing the market. And if you missed the 5 best days, you would have missed out on 10% annualized returns. I'm like, yeah, but if you missed out on the 10 worst days, you would have missed out on 20% returns. Like, they don't show you the other side. And I think it's the challenge with the information is not just the information itself, but it's also how they present it. And if they present it in such a way that shows what they want you to see, which is very common everywhere. So I don't mean to bias major media, investment banks. Every industry does this. They bias what they want you to see. It's sales and marketing, effectively. So you have to look at the whole picture and you have to stop and say, all right, what story are they trying to tell me? And what is the other side of that story? What are the pieces here that I might be missing that I should look at and say, okay, this is an important piece that's not being shown. So Megan's point, really research the data. So Barb, I want to ask you, and I'm going to come back to you, Megan, as well. So knowing that a lot of this information is biased, untrustworthy, or deliberately dishonest, where do you go to get data? Like, where do you find data? I mean, you're a seasoned vet in portfolio management. You're no slouch yourself. So how do you find good data?
That is a wonderful question. And you have to go to reputable sources. And I'm going to go on a little rant here and talk about some of the crap you see on the internet, where I get these commercials on my Instagram of some guy or gal telling me about investing. I just came out with my new course. The kid's 20 years old and has no experience. So first of all, you have to look at the credentials of what you're reading. Megan talked about going to the JP Morgan site. I would say any of the big financial houses, Vanguard, Schwab, Fidelity, E-Trade, any of the big financial houses, Merrill, JP Morgan, they all have deep research departments. So even in a blog that you're reading on their sites, you're going to likely get some really decent information. Investopedia, which I happen to write for, has very strict sourcing requirements. Everything that I put out on Investopedia, as well as the other journalists who write for that website, have to cite the source, and it must be a primary source. And if you want more information, we footnote our information.
I think that's a really important thing, Barb, with the financial history, because financial history is becoming very trendy, right? And what I would tell anyone when you're going down the path, and I think this gentleman's book is, from what he has a blog too, which I went on and read. So his stuff is very well documented, but always look at the footnotes, right? Look, are you dealing with the real source document, or is it gossip and innuendo? We've become a society where things like influencers are giving advice, and they're not always giving it from a place of fact. I'm not saying all of them don't do that, but there is that sort of, there's a frenzy about it today. Facts are loosely used. And so one of the things that I was trained on early in my career was thematically, when you are looking at data, historical data, and this was at Goldman, they train you on this, is you want to be thinking about 3 threads. And I tell people to think about this all the time when they're trying to discern information. One is the US economic, political, historical situation. The other is Europe, right? What's going over there. And the rest is the emerging markets, and predominantly things like China, right? What are going on economically, politically, as you tell the story. And you really want to make sure that that is being backed up in facts. So one of the things that I think, is always interesting in the high net worth space is every year when the Goldmans and the Merrills and the Morgans send out their economic outlook, which are like, 100 pages, it's actually told as a story. They have a theme and they keep the theme throughout the entire outlook, and they tell you the story so that you can connect to it and remember it. And I think that's really, really important. So think about when you're going through the data, like Barb's talking about, also, what is the story you are trying to tell of your portfolio?
So I want to point out what you just said, Megan, because I think it's really important. So what you're talking about are some of the big firms that put out these huge reports. JP Morgan is a famous quarterly report. It's like hundreds and hundreds of slides and data, and it's great. It's great sifting through it. I almost don't have enough time to do it. But,
and by the way, they always have pictures of like boats and compasses and right, like that's sort of the theme always.
Yeah, I mean, their marketing department, A+, they do a great job. But I think the point I want to point out that you just said was they create it as a story, right? So the individual slides are not inaccurate. They're not biased. Well, I don't know if they are, but I'm assuming they're not biased. They're not inaccurate. They're not propaganda. But as a story, right, they have a theme or a story they're trying to tell, right? It might be emerging markets are doing well or they're not doing well, whatever the story is. All the slides they put together are basically supporting that story. But then the question is, well, are there slides in there that are not supporting that story? Because you read all this and you're like, wow, I totally buy into their thesis. And their thesis might be correct or it might be wrong, right? Nobody can tell the future. But the story is what sells, right? And in Wall Street loves a good story, and people love a good story. So, and those of you who are listening to the podcast, Megan is coming out with a good story with her book, so please read that when it comes out. It's not out yet, but I can't wait to read that book, Megan. Just a quick plug. You're welcome.
Thank you, Kirk. Next year.
So, but I did want to point that out because I think that point that she made is really important, in that everything comes down to a story. We all get convinced. You could read data. Like I've seen like newsletters, it's just data. It's like, it's sterile, it's uninteresting. But then you read a newsletter that tell you this big grand old story and there's like 5 seconds of data. It's like, ooh, I love that. I want to believe them. Like, well, I don't know if it's true. It's just a good story. So just understand how you're being, I hate the word use the word manipulated, but influenced in a certain direction, because data is easy to look at. Stories are really hard to ignore.
Yeah.
So,
and it's one thing I always tell my team when those outlooks come out, I'm like, that's the best job on Wall Street, because they're never held accountable for it. Right. Yep. Like by the end of the year, you could look back on it and be like, none of this happened. I mean, who would have predicted COVID for the 2020 outlook?
Well, I don't know. I haven't seen these much anymore, but they used to have these like annual predictions. It was like Barton, Biggs, and a few of the other like famous people who had their annual predictions, and they're famous. Everybody looked at them like, oh my God, this is so crazy. And it was like, maybe one of them would come true. And then they'd be like, look at that, I was correct. I'm like, what about the other 9? Like, where did they go? They just kind of disappear in the dustbin. But I think it's hard because we all want answers. And I think that's the lesson here, is we all want answers. If we don't have information, if there's a void of information or direction, people want answers, and somebody giving it to them, they just gravitate towards that person, say that must be correct, because they want an answer. It's a human thing. Like anywhere, like, oh, what happens after death? I don't know. Like, well, people don't like that. They want an answer. So I think there's a lot of this that's really important to understand about yourselves as you're gathering information. So Barb, I want to ask you, what should people be reading? I mean, because you get all this data. Nobody wants to look through the government data. That's no fun, assuming it's accurate. But where should people be looking? What should they be reading to get smarter about this sort of stuff?
Well, you want to look at the credentials of the author. So I mentioned definitely consider any of the publications or research from the big financial houses, but they're not the only ones. Morningstar has very well-sourced information. And for some of you out there that are not as nerdy as the three of us and just want an overview, like a Cliff Notes version of what's going on, well, you can look at some of the, I would say maybe the popular writers on online and look at their credentials. So does someone have a PhD or a master's degree in finance? Are they a CFA, a certified financial analyst? And then you look at who is writing the information and look them up on LinkedIn. What is their background? And that will tell you, because some blogs out there are amazing. You've got like really smart people who are, big time financial brains disseminating very interesting and important information. So, research a topic, plug it into Google, and then evaluate the source.
Great. So Megan, I want to ask you, because you're writing the book, what's your favorite part of financial history? Do you have a favorite part or story or?
So my book is All the President's Money. And it's about how different presidents manage their money, looking at certain skill sets that we have in modern day financial planning. So what I have found interesting in studying this is how many, we go through the markets and it's going up and down and up and down. And it's been interesting reading that type of different marketplaces the US has gone through that feel very similar to today and the impact it's had on some of their wealth, right? So Jimmy Carter is a great example. His father dies in the 1950s. He leaves the Navy. He was a nuclear engineer. He had a really big job. He was on this great wealth trajectory. He leaves and he goes back down to Georgia. And in the 50s, there was all this apprehension in 1952, 1953, because the Korean War was ending and the Fed was worried about inflation spiking. And so it was sort of interesting reading about this is like Carter trying to navigate the family farm with an environment from an interest rate standpoint like today. And so I find reading this stuff really interesting because most of them go through periods of things that all of us have. And I will tell you the one last thing I'll say is, I find the time period of 1870 to 1900 very reminiscent of what's going on today, right? There's a lot of commonalities to it. Back then it was the advent of the railroad and the department store, and now we're all on Amazon, and but again, history doesn't repeat, it rhymes. And so what I have enjoyed about it is seeing the fact that our country has been able to withstand a lot of these financial stresses, even though in the moment the newspapers are saying, is this the end of America as we know it, right? Or will we ever get back to where we were financially?
Yeah,
if that answers your question.
Yeah, it does. It does. It's great. I appreciate that. As they say, if those who don't know history are doomed to repeat it. And I want to ask you, Barb, because you said this before the show that you think that history doesn't repeat itself. So how do people prepare for things that don't repeat?
No, I actually did not say that.
Oh.
I said, I am worried. What if history doesn't repeat itself?
Okay, my bad.
No problem. I love the opportunity to correct you on air. This is like making my day because you're so rarely wrong. So what if history doesn't repeat itself? The thing that all of us who've been in the financial area for years always say, that you've got to be invested in the investment markets, the stocks, the bonds, the financial assets, because even after a down period, the trend is going up. And I say this all the time myself, because that's what's happened in the past. And over the past 100 years or so, the aggregate stock market index has returned in the neighborhood of 9% on average every year. But what about 2022 when it dropped in double digits? If you got into the markets in 2021 and then you saw your investments drop 20% because someone told you you should put 100% of your liquid assets in the stock market, the history wouldn't be making you so happy. So my concern is, just because something has happened in the past, are we 100% certain it's going to happen in the future? And I have to say, no, we are not. Nobody knows the future. And so how do you contend with that? And at the risk of blabbering on too long, I believe a reasonable remedy is simply asset allocation. Look, your cash may lose purchasing power. If you're earning 4% return on your cash and inflation is 6%, you're essentially losing 2% of your buying power. But you will not lose your principal investment in cash. Whereas if your stocks drop 30% in a year and you needed that money the next year, you're in a bad way. So the benefit of diversification is you're going to smooth out the ups and the downs. You're never going to make the return of the best performing markets, but you're also likely not going to lose the amount of the worst performing markets. And although we don't know the future, we can guardedly, optimistically expect that as long as businesses continue to grow in the world and in the US, then we're going to eke out positive returns on our investments.
Right. Yeah, I think it's funny. Wall Street tends to, if you look at history, as Megan said earlier, it doesn't repeat, but it rhymes, and that's a Mark Twain quote. But the funny thing is Wall Street loves talking about how things repeat. They don't, like you see these charts all the time, like, well, in every 4-year presidential cycle, the third year is the best, and the second year is the worst, and of this stat and this stat, here's how it perform, and out of the 10 last times the yield curve inverted, every single time it's been a recession. People love to talk about that stuff, and maybe the probabilities are such that they're in favor of that, but at the same point, it doesn't mean it's going to happen. Like, we still haven't had a recession after this hugely, probably the biggest inverted yield curve we've had, at least in recent history that I could find. And yet we still don't have a recession. Now, I still believe we'll have one, but you just don't know, right? You don't know if history is going to repeat. But one thing I do want to point out is I do like the fact that if you look at history, it helps shape your thinking. Because we talked about earlier in the show on how, if you look at the markets, everyone thinks, look at history and be like, things are golden. Everything's easy. The stock market's just going to keep going up and up and up and up to the moon. But what if it doesn't? And people say, well, that's obviously not going to happen. Well, I don't know. Look at Japan. Japan's had negative returns for 30 years, 32 years. I think they're probably close to breaking out. But if you had put your money in 1990, and I think it was January of 1990, you put your money in, you would have lost money for 30 years. Well, we're not Japan, but it's an example of something that happened. What about the 70s? What about the 2000s? What about, all these examples of history where things don't work out perfectly. And I think it's important to use that instructively, just to look at, not to say that it's going to be exactly the same, because I talk about in the show a lot, we're going to be like the 70s. I don't think we're going to be like the 70s. I think it's going to be very similar, though, in a lot of aspects that people don't understand. And what we can learn from the 70s is what happened, why it happened, and what were some of the ways that people felt. So this is why I love what Megan's doing. She gets to learn about history and how people are going through it and how they feel. What I'm interested in is, how are people feeling during that time? Because you can look at the data and say, oh, this happened clinically, but how are people feeling? Are they feeling the same as they're feeling now? Like, for example, like one of the things I read a while ago was one of the biggest markers of the 70s was mass confusion. Nobody knew what was going on. They didn't know why it was happening. They didn't understand the direction. People were just really confused. Well, we're seeing that now. Where's the recession? Why are we not in a recession? High rates. Why are real estate prices not going down? The point is that you get into these periods and sometimes data doesn't make sense because you're looking at an old paradigm from like pretty much the 1980 until 2021, I think it was. You had one paradigm. We might be in a new paradigm where all of the things that you thought were true are no longer true. So it doesn't make sense. The 70s, same thing. All the stuff people thought prior, once the 70s hit, they didn't make sense. I don't understand. Why is inflation high? Why do we have stagflation? What do I do? How do I handle this? And I think the challenge is we don't appreciate history enough to go back and say, okay, this is how people felt. It's similar. I should take that into my thinking and say, okay, there's something missing here. What am I missing? What is not accurate? Just because Wall Street says the prices should be where they are, it doesn't mean they should be. Why are the prices so high? Why are real estate prices so high? Does it mean they deserve to be there? I don't know. I don't think so, but I'm not, it doesn't mean I'm correct. I just think that maybe Wall Street hasn't priced it in yet, right? Maybe they haven't appreciated where it is. And at some point it may be priced more accurately, but it could be 10 years, right? So we don't know. So the point is to understand history, to understand how to think about the markets, how to think about economics and really your financial life. So
Kirk,
yes,
I've got to chime in. I
Please
can't
do.
keep this inside. I remember back in the late 70s where a friend of my father's was talking about how he was investing. And at that time, he said to my father, I am investing in 12% yielding.
Was this when he came over for dinner?
Yes,
I've heard this story
I know.
before.
I can't help it. I have to tell it again.
No, I love it. But now we know the story's real because you repeated it.
Well, yeah, or else I'm a really good liar. But he invested in 12% U.S. Treasury bonds. Now, unless the entire U.S. goes to hell in a handbasket, the U.S. is probably going to be standing for the next 10 years. So we have to be flexible as investors. Those of you who are 100% in the stock market, you know, if you see these really juicy, and you'll only know if something is juicy if you can look at it in a return is juicy if you can look at it in context of history. And so, for example, if you can snare a bond, a secure bond that is paying double digits and is highly rated, or a U.S. government bond, we have to be flexible enough to say, this might be an opportunity. Maybe I should do this instead of being all in the stock market today.
Yeah, totally agree. So as we I want to ask Megan one more question before we wrap it up here is, so of all the things you've learned about studying history and the president's money, like what was the best lesson that you took away from that? Like what's something that the listeners could learn from your experience?
Yeah, I mean, I think that you can never underestimate the power of luck in wealth. And we build these stories about luck and how it works. And what I was really interested in studying a lot of the research on luck and applying it to the presidents is, what is the best way to bring luck into your financial life? And the answer is boring, but then anything in good investing is boring, which is you need to be consistent. And that's really important. And I brought up Jimmy Carter a little while ago, and it's a big PR thing that he was this peanut farmer and they make him sound like he's podunk and not that educated. He was a very sophisticated guy. And he went in and took over his family's farms and turned it into this giant operation. But when he went in after his dad died to take over the farm, everything that could go wrong. Inflation spiked. There were labor issues. There was a drought in Georgia, like everything that could go wrong. And Carter was just consistent. And finally, the worm turns and it works in his favor and the business takes off. So I think for me, I try to keep that in mind now after reading. There's a lot of great, by the way, they study luck constantly. There's tons and tons of research on luck. But I always try to keep that in mind, is that be consistent even when things aren't working in your favor financially, because if you are consistent in how you approach it, it will eventually work in your favor. So that's been my big takeaway.
I like that. I like that. We should talk more about luck on the show. There's some really interesting study going on, and
I've actually, there's been a really good study. We may be able to get the author on. He's a really interesting guy, but it's crazy luck.
Yeah, that's cool. All right, so Barb, wrapping up, final thoughts from you.
I loved what Megan said, because a lot of us don't appreciate our luck as well. And I have to put this out here because we are 3 white people here, and just by the luck of our birth, and we've been born in the United States, the most, arguably the most wealthy country in the world, in a race that is, for better or worse, had less discrimination than people of color. And you can't take credit for that. And also sometimes our luck in investing, we hit on a great investment. Okay, does that mean we're the smartest guy or gal in the room? No, it does not. It means a portion of our success is based on luck. And I loved that, because sometimes we take credit for stuff which we shouldn't.
Barb, it's funny, I don't mean to interrupt, it's funny that you bring that up and where you're born. When they do study it, the 2 things that matter most is where you're born and what income segment in that environment. So all Americans are quote unquote lucky.
Yeah,
exactly. And you can control what you can control. And I think that is the bottom line. You can control how you invest. You can control contributing to your 401k in a balanced portfolio. You can control spending less than you earn. And the things that are controllable, if you want financial security, require discipline. Simple as that. I'm Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance and on YouTube on my Barbara Friedberg channel.
Great. Thanks for coming on, Barb. Megan, final thoughts from you.
Yeah, I mean, I think we talked about a lot of stuff, but when we talk about being here before and history repeating, I'm always struck by the fact that in researching my book, I got to read a lot of the president's letters and diaries, and they're very much regular people. And it always strikes me that Harry Truman wrote to his wife in a letter, because she didn't spend a lot of time in Washington when he was president, that he was up at 2 a.m. worried about money. Right. And I think that's the most American thing out there, because I wake up at 2 a.m. Worried about money. And so I love the fact that good old Harry and I feel the same way. But I think it's true. Like when you look back at past historical periods, I think it'll allow you to create stability and center yourself on how to navigate the financial markets. So I'm Megan Gorman. You can follow me on Instagram at All the President's Money. Kirk, thanks for having me on.
Thanks for coming on, Megan. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.